Good morning, everyone. My name is Stephen Giuliano, and it's my pleasure to welcome you to our third Waypoints virtual event, Financial Planning. The Waypoint series of virtual events was developed by Presbyterian Senior Living to help you navigate the senior living journey, and we're looking forward to sharing a lot of information with you today. Today's presentation is being recorded, and a link to access the recording will be sent to all participants after the event, allowing you to access the recorded content at any time. During today's event, we'll begin by hearing from Jennifer Ciore, Corporate Sales Director here at Presbyterian Senior Living. We will then be joined by our Vice President of Finance, Cindy Hoffman, to discuss entrance fees. Next, Maggie Boley, Vice President of Resource Development, will join us and discuss PSL's not-for-profit difference. And finally, we'll hear from Bill McMorrin from Green Oak Consulting Group, who will discuss how you can prepare for your financial future. Throughout the event, you'll have the opportunity to submit questions to us by clicking on the Q&A button at the bottom of your screen and typing in your question. In the event that we don't have time to answer your question live today, we will respond to your question via email after the event. With that, I would like to introduce you to Jennifer Ciore, the Corporate Sales Director here at Presbyterian Senior Living. Thanks for being with us today, Jennifer.
Hi, Stephen. Thank you so much, everyone, for attending. So the big question posed when looking at CCRCs is, how can I afford a CCRC? My mortgage is paid off. I've owned my home for 20, 30, 40, 50 plus years, and I've invested so much time and money and memories in my home. People often say that while they'd like to move to a CCRC, they believe staying in their home will be less expensive on a month-to-month basis, but that's not always the case. Even if it is close to the same cost to live at home versus a CCRC, there's many other things to consider. So the first thing to consider is your home's mortgage, which would be the biggest monthly expense. Many seniors are living in their home that's already been paid off, which is great. So in this case, the equity in the home is a common source of funding for a CCRC entrance fee, as well as potentially the monthly fees charged by a CCRC. Utilities are another considerable expense for those who live on their own, and they continue to increase every year at a much higher pace than Social Security. The cost for your home's electric, gas, water, sewer, phone, cable, internet, and other miscellaneous utilities can add up pretty fast. When living in a CCRC or other retirement community, most, if not all of these costs are included in your monthly fee. You will want to ask these questions when inquiring or visiting the communities just to verify. So homeowners insurance and property taxes are very expensive for homeowners, especially in states and counties that are considered the high tax states. In our CCRCs, there's no extra fees for taxes or insurance, but we do recommend signing up for renter's insurance to cover your personal belongings. But it's just a minimal cost per month. Other miscellaneous costs that come with owning a home, like trash removal, snow removal, HOA fees, lawn, landscaping services, housekeeping services, gym memberships, and most home repair costs will also be included in the monthly fee at majority of our CCRCs. You must also consider your monthly food expense. So most of our CCRCs will include at least one meal per day as part of the monthly fee cost. But the meal plans are becoming more flexible and the options vary from community to community. But just the convenience of having the dining area on a campus is valuable. So you don't have to leave the community or pay extra fees for delivery costs to have access to food. So this next sheet here is our cost comparison worksheet. And this is included in the workbook for all of our CCRCs. And it's a great way to figure out how much you're actually paying while living at your home versus living at one of our communities. So the inclusions vary by community, but our sales team find that many prospects come back after filling this out and they say, I can't believe how much I'm actually paying to live in my home, and I don't have the freedom and the maintenance-free lifestyle that I could at a CCRC. So let's review some of the components of the cost comparison sheet. We have filled in some sample amounts here, but your expenses will vary depending on the age of your current home, your current transportation situation, obviously your geographic location. So let's go through each category here. Under housing and utilities, what we did is on the left-hand side, we gave an estimate of the monthly cost in your present home versus a PSL CCRC. So we're really looking at averages here. Our panel of experts have filled this out according to their geographic location and what their average applicant is paying per month in their home, and then the average cost at their community. And so what I did is I averaged it all out. So some of the numbers you see here, you might say, hey, I don't pay that much in my home, or wow, I pay a lot more than that. So please consider that as we're going through here. So the first item under housing and utilities is insurance on personal belongings. So we do ask that you get renter's insurance when you move to a PSL community, and that's approximately $10 per month. It's very minimal. In your home, it's probably going to be more because you're going to have more things when you're living in your home. So when you're downsizing, the cost of, or the value of your personal belongings will be less. Property insurance, we averaged about $100 a month for that and $450 a month for property taxes. Now, I'm sure you pay it on a yearly basis, but we broke it down by month here. And at our communities, it's included. Rent, mortgage, monthly fee. So the average monthly fee at our communities is $2,500, and it certainly could be less at our communities or more. So reach out to the communities to be able to plug a number in here for you. But we assume that you paid off your mortgage. So we put $0 here, but if you have a mortgage, if you're paying a monthly rent, if you have a line of credit or home equity loan, you want to plug that number in there. Condominium, homeowners association, that's included with our cost, and we assume $75 a month if you have to pay extra fees for someone to, for HOA fees. Electricity, gas and oil, about $150, that's included in our communities. Telephone, around $50 a month, and our average telephone cost for a landline is $35. Water, sewer, around $75, and I know you probably pay that quarterly, so we broke it down by month here, as well as trash removal. So that's about $75 and $25, about $100 a month, and it's included in our monthly costs. And then internet and cable, we assumed a triple play is what you'd have here, so about $150. I know some areas internet is very expensive, and so is cable, so this could always be flip-flopped. But at our communities, you do pay for internet. It's around $40 a month, and cable TV is included at most of our communities. So home maintenance, cleaning, this is a very big expense that you probably don't think about. And you'll see on the right-hand column are all zeros. So this is included in our monthly fees at a CCRC. So house maintenance and repair, you have to assume you're going to have some major repair or replacement that you have to invest in every year. So we estimate around $300 a month. Housekeeping services, $100 a month, and this could even include cleaning supplies and things like that. Appliance repair and replacement, this is assuming that you have to repair or replace at least one appliance a year. And if you're not replacing it, just think about, you know, having to change out filters and just those extra costs to maintain them. Lawn care, $50 a month, snow removal, $10. And again, miscellaneous routine and major repairs and security system. We put 25 there, but from what I hear, it could be more than that. So that's pretty conservative. And at our communities, again, that's all included. Now, the one thing that may not be included is housekeeping services. Many of our communities have a certain allowance that they give per month. Many do not. You have to pay that a la carte. So food and entertainment, our communities have dining plans, have several dining venues. So the meal plan is something that's included in the monthly fee that you'll pay. And we gave an estimated $400 for meals when you go out to order meals, you know, delivery at your home. So that can really add up. And then household supplies, these are miscellaneous supplies you're going to need to keep in your home to maintain, so about 75. You'll still need that in your home at a CCRC, but probably not as much because there's going to be less space. And then clubs, organizations, activities, around $50 a month. At our communities, our activities are included, as well as exercise and gym classes, fitness classes are included. So we left 0 there and assumed $50 on the left-hand column. And groceries, if you're not having to go out and purchase groceries as much, if you're eating meals at our communities, you know, our rates are very reasonable. We have grocery items right at the community. So just the convenience of having the food and entertainment all under one roof is going to be less than what you pay in your home. Transportation, just going out to those places to eat and your clubs and activities, you're going to be paying more in gas. So we assumed 200 versus 100 at our community. And, you know, transportation, weekly transportation and scheduled transportation, if you, you know, need to pay extra for that, you'll want to plug that in. We just put $0 there. We bundled it all up in the first line. Wellness expenses, you'll probably still be paying the same amount for your health and long-term care insurance at our community versus at home, but we wanted to plug that in as well. And then Police, Fire, and Ambulance Association is about $10 a month you pay in your home, and it's included at our communities. So when you look at the total estimated monthly expense, you're right around the same costs being in your home versus being at one of our communities. And again, this is assuming that you don't have a mortgage or a home equity loan or, you know, those extra costs. So really just the peace of mind and the access to continuing care, time and effort that you'd spend searching for, scheduling, coordinating services, is priceless. You can't put a value on that. So now it's my time. It's my pleasure to introduce you to Cindy Hoffman. She's our Vice President of Finance at PSL, and she'll walk you through the resident investment fee, our entrance fee programs that are offered at our CCRCs. Hi, Cindy.
Hi, thank you, Jennifer. So what is an entrance fee and why does it matter? I'm going to be covering this section of the program today. So when looking at senior living options, many people ask, why would they pay an entrance fee at a CCRC versus just paying a monthly rental at a senior rental community or staying at home and paying for services a la carte as they need them? Well, at a CCRC, typically entrance fees make it possible for the community to offer a reduced monthly service fee. So you save monthly compared to rental fees at other types of retirement communities. When you buy into a CCRC at Presbyterian Senior Living, you know that you will have access to assisted living, skilled nursing, and memory care for the rest of your lives, even if you outlive your financial resources. So that insurance plan is really peace of mind that you cannot put a value on. If you need assisted living or skilled nursing while living at your home, you may have to move to a community that has availability at that time, and it may not be one of your top communities where you really want to move to. You and your family will also experience the burden of selling a home and your belongings under duress, and you may not be able to sell or pass down your belongings in the same manner as if you were preparing for this move in advance to a community that you love and would love to live at. Our PSL communities offer several contract options. There is a life care agreement, which provides unlimited skilled nursing and personal care or assisted living care without any additional fees. A monthly premium is charged to residents with life care agreements. At PSL, we offer the life care contract at Cathedral Village in Philadelphia. But with most of our contracts at PSL, we offer what is called a fee-for-service contract, also sometimes known as a Type C contract. With this contract, the entrance fee and the monthly fees are based on the size of the unit, the type of the unit, the number of occupants in the unit, and also the level of care being provided. Many of our agreements provide 14 days per year of skilled nursing care at no additional cost. We do also offer rental agreements at several of our continuing care retirement communities and at our standalone market rate communities. If a resident enters into a rental agreement, the resident is not required to pay an entrance fee at one of these communities. Instead, the resident pays a one-time community fee and a monthly service fee. But the monthly service fee may be higher here at this community than the communities where you pay an entrance fee up front. Contracts also should include the clauses about refundability. What that basically means is how much of the entrance fee you and or your loved ones will be reimbursed if you leave the CCRC or pass away. Typically, the amount of the entrance fees returned to the individual or the person's estate depends on how long you live at the CCRC. So to accommodate residents with varying estate planning requirements, we typically offer two entrance fee payment plans. The 50-month refund plan, which includes a lower initial entrance fee, but provides no refund if the resident's agreement is terminated more than 50 months after initial occupancy. We also offer the 50% and 70% refund plans, which involves a higher initial entrance fee, but provides for a refund of 50 or 70% of the entrance fee upon termination of the resident's agreement, which will go to the resident or to their estate. Now, regarding payment terms, we have an installment equal to 35% of the entrance fee that is payable at the time that you execute the resident's agreement. The remaining payment of the final 65% is due when you occupy the unit. The entrance fees are subject to change for future residents at any time. From selling your home to making use of long-term care contracts or long-term care insurance, there are several ways to pay for a CCRC. Your strategy will likely depend on your individual preferences, your assets, and your insurance. Bill McMorran will talk more about this in his part of the presentation today. So when considering the costs, when calculating the cost of moving to a CCRC versus staying in your home, perhaps maybe the number one cost to consider is care services. Generally speaking, there are two options for in-home care. You either hire someone to provide the services you need, or you have an unpaid loved one perform those duties. Now, the average hourly cost for a caregiver or home health aid services hired from a home care agency is $19 to $24 per hour. And in-home skilled nursing care, usually provided by a registered nurse, can range from $13 to $30 an hour. So for just 20 hours of in-home care per week, that's part-time care, the cost can range from around $1,600 to $2,400 each month. Now that's a hefty price on top of the other expenses that Jennifer just mentioned. But the cost of having an unpaid loved one serve as a caregiver can be even greater for you. Consider the cost savings both financially and emotionally for you and your loved ones when considering moving to a CCRC. So now I'm going to hand it over to Maggie Boley, our Vice President of Resource Development, to talk about our charitable care program.
Thank you, Cindy. Good morning, everyone. It's nice to be here with you. Philanthropy plays a big part in what PSL is all about. We are a 501c3 organization, and as such, contributions made to us are tax deductible. The Office of Resource Development is the focal point for charitable efforts, and we are tasked with working with donors to provide opportunities to support PSL in a way in which the donor can realize their charitable goals. We offer community support in three different areas. First, in the provision of benevolent care. Second, in support of scholarships and education. And we do this because we believe we have a responsibility to staff to help them be the best caregivers they can be. Scholarships in education help staff to improve themselves and in turn to be better providers of services for our residents. Lastly, the area of quality of life is covered, and that is for capital items that are not typically budgeted or for the provision of resident enhancement activities and events for those who are in our skilled nursing, assisted living, or personal care communities. Benevolent care represents the spirit of caring for each other. It's at the heart of what we do at PSL. And it started all with a farmhouse being donated by a lady by the name of Ellen Parker, who offered her facility to us to care for 9 single elderly adult females who were without a place to live. Since that time, Philanthropy has helped to ensure that there is a place for everyone and that benevolent care is provided. The reality is that residents are living longer than imagined in earlier days. And as we move through the levels of care, sometimes our resources are depleted. PSL helps to ensure that protection against the unexpected is there and that benevolent care will be able to pick up where your resources leave off for as long as you need that support. We are here to help. Supported by residents, staff, and the larger community, we are dedicated to meeting PSL's charitable needs. Our team works closely with many donors and with organizations, with our staff, with our vendors, with the community at large to ensure that the needs of PSL and especially of our residents are being met. Lastly, we want to welcome you into the PSL family and hope that you will find that this is an ideal place for you. Thank you for your time. And at this point, I would like to introduce to you Bill McMorran, the owner of Green Oak Consulting, who will talk about planning your next steps.
Great. Thank you, Maggie. Good morning, everybody. I'm looking forward to showing you just how some tax strategies can work for you in making your steps, the financial considerations you need to make, how to get your house in order. Just as you organize your belongings, you want to make sure that your financial and your estate planning materials are in order as well. So we're going to talk about some of those basics going forward. But before we start, I always like to make sure we have the basic ground rules in place. First of all, everyone has a different perspective about money, about where they live, about what is important to them. And there are no right answers to any of this. It is what is best for you, what is best for your loved ones, and what you feel you'd like your future life to be like. Today, and any day, there's no pressure to take any actions. Our job is to give you good information so you can make informed decisions on your own, and always, always talk to your own advisors. I can't stress this enough because your advisors, your family, your CPA, your financial planner, your attorney, who knows? Sometimes it's your cousin Frank. I don't know. Talk to your own advisors. And before we go to the next slide, I just want to make sure that I disclose some critical information. First of all, I do have a brokerage stock license. So I hope that no matter what I say about stocks or investments, you will talk to your own advisors. Also, I think that I have a life insurance license. Anything I say about life insurance, please ignore that too. And finally, I went to seminary and I'm an ordained Presbyterian minister of all things. So anything I say about religion, again, one more time, please talk to your own advisors about religious issues and don't listen to anything I say about it. So those are our ground rules going forward. What I want to look at next are some of the core documents and strategies that you need to have in place, regardless of where you live, what you want to do. The starting point is, can you list your assets? Nobody likes to list them because you always worry about forgetting something or it's too much work, but you really need to have a sense of what your assets are. You need to know what's inside of your pension plans as well. If it's all company stock and the company goes bad, where will your pension be? There's a lot of emphasis now on assets that are held in pension plans. So it's important to pay attention to what you are doing inside of yours. And then most importantly too, do you have an estate plan? An estate plan sometimes is really frightening because it's like, well, when I'm not here, what's going to happen? And doing an estate plan is essentially a way for you to say, what do I want to have happen when I pass on? Very simple. These are the basic things. List your assets, know your pension plans, form an estate plan so that you can control and shape what your future and the future of your loved ones will be. So that's our starting point. Let's look at some of the critical documents that you need to have to do this. The basics are medical power of attorney. That is that if you are hospitalized, let's say, and you're comatose, who is going to work with your healthcare providers to make your medical decisions? So you need to make sure someone has medical power of attorney so that he, she can inform, the providers what you would want to have happen. You want to have someone who has financial power of attorney as well. Someone who can write checks if you have a broken wrist. Someone who can take care of the bills if you're incapacitated. And also, just as a lot of attorneys say, don't have the same person have medical power and financial power, just as a safety precaution. 99.9% of the time, not an issue, but it can happen problems. Do you have a living will? This is what's called an advanced care directive. Basically, it says, listen, doctors and nurses and hospitals and healthcare systems, if I am in a certain situation, I want you to do this, or I do not want you to do it. I do not want you to prolong life, for example. I don't want to have intubation. There's so many things in your advanced care directive. It's really important to make sure that, again, you spell out what your wishes are. And that then brings us to estate documents. And I say, or maybe not. Basically, there is a will. A will is something that is probated, that goes through the court system. It is filed, it spells out exactly what you want to have happen, and it becomes a public record. The other option is a living trust. And a living trust is a simple, clean way of when you pass on, you don't have to go through court. It's a private document. The trustee of your trust can simply dish out or serve out whatever you wanted to have happen very cleanly. And again, I live in California, and a lot of people in California use living trusts simply for privacy's sake, as well as there is a very high cost of probate out here, and it's a very slow process. So talk to your attorney about what is best for you. There is also something, we don't have the slide up, called transfer on death. And some people, what it is you have an investment fund, and you say, when I pass on, this goes to this person, transfer on death. And it's a very simple process. Again, you need to talk to your own advisors about what is best for your estate plan going forward. Looking ahead, let's talk about CRSA 2021. If you wonder what that stands for, remember, I spent 10 years in Washington. I love these things. It stands for the Coronavirus Response and Relief Supplemental Appropriations Act of 2021. And we can put it up if you want to spell it out, but it's simple just to say recent legislation. What it did was it allowed your charitable gift amount to become $600 for couples. And this says above the line, because only less than 20% of people now itemize their tax deductions. A lot of people don't get full credit for their charitable giving. And so in the original CARES Act, they passed legislation that said that anyone can give up to $300 in cash to charity, and they can deduct that $300 from their income before the tax is calculated. That's called the adjusted gross income. But a lot of couples said, well, great, do we get 600? And the answer was no, legislation didn't say it. So the late 2021 Act amended it and corrected it so that a couple can now take $600 above the line in 2021. The medical deduction threshold also has been reduced permanently to 7.5%. It used to be 10%. And what this means is that if you itemize your deductions, it used to be that you'd look at your adjusted gross income and you could only deduct your medical expenses above 10% of your adjusted gross income. So if you had $100,000 income, you could only deduct any medical expenses in excess of $10,000. Basically, the medical deduction has been lowered to 7.5%, and it means that you can get more medical deductions faster than you could before the passage of this act. And then finally, this is always the people like this clarity. In 2020, because the market had tanked so rapidly in March, the CARES Act basically was passed in late March, and everybody was worried that their IRAs, the traditional IRA, not the Roth IRA, the traditional IRA would be so penalized because it had already been determined how much should be paid out for that year, that Congress suspended required minimum distribution. Required minimum distribution essentially is because the money grew tax-free inside of your pension plans, your 403B, your 401k rolled over to an IRA. What the government says is we want our money sooner. And so what they have said is the required minimum distribution, you have to take money out of your IRA each year, and it's a percentage amount. It starts at around 3% and goes up to 8 or 9% when you're older. But the required minimum distribution is 99% fully taxable. So it is a tax issue. And so when they didn't require you to take it in 2020, they are requiring you to take that tax hit again in 2021. So this is what the Coronavirus Relief Supplemental Appropriations Act of 2021 allowed for changes. And this just passed in late December. So basic stuff you need to know going forward. Let's talk about another tax act was passed in late 2019, and a lot of the issues around this were sort of obscured by the COVID crisis that emerged a few months later. The SECURE Act stands for, oh my goodness, setting every community up for retirement enhancement. Setting every community up for retirement enhancement. So what it did was it allows you to make contributions to a pension fund at any time, so long as you have wages. Now, in the past, you could only make contributions up until you started having to take your required minimum distribution. Now, if you're 80 years old, you're taking your required minimum distributions, and you have a job that have wages, you can put money into your retirement fund as well, and then take it away from your income at the same time. The other thing that SECURE Act did is it raised the required minimum distribution age from 70.5 years to 72 years. And this is awesome because you now have a year and a half more if you're turning 70 this year. You have a year and a half more of income to grow tax-free inside the IRA, and it allows you to be richer when you have to start taking, and I say ideally richer. Who knows what the market will do? Talk to your own advisors. It allows for a higher level potentially of income for you. Here's the crux problem of SECURE though, is that before SECURE Act was passed, if you had, remember your IRA is outside of your estate plan. It's not part of your estate. It is a separate taxable entity. And so when you pass on first of all, you would leave it probably if you're married to your spouse, and you can do that automatically. Or if that not your spouse, then it could go to your beneficiaries, other beneficiaries. And in the old days, before SECURE, you had unlimited time for your beneficiaries to take the money out of the IRA. It was called a stretch IRA. And so a lot of people, the wisdom was that you did it for your grandchildren who had very low tax basis and very long time to live. So it would grow as a steady income stream to them for many years into the future. So it was almost sort of a dynasty type of giving. Well, Congress didn't like that. So they now say that whoever the beneficiary is as a person, unless it's your spouse, unless it's a disabled person or a couple sort of exclusions, the heirs have to take it all out in 10 years. So now you need to rethink who your beneficiaries are over that span. And again, there's no rules of saying you have to take out 10% a year. It's basically at the end of 10 years, the IRA has to be empty. That's all. The other thing that was important is qualified charitable distributions. I don't know if you're familiar with it. A lot of people are becoming more familiar with qualified charitable distributions. What a qualified charitable distribution is, you have the ability, if you have an IRA, a traditional IRA, you are over the age of 70 and a half, you can tell your IRA custodian to send money from your IRA directly to the charity or charities that you want to receive gifts, you want to give gifts to. And if you do that, and it is at least equal to or more than that required minimum distribution thing we've talked about, then you don't have to take your required minimum distribution out, and you don't have to pay taxes on that income. So what we're seeing is that people are increasingly relying and using qualified charitable distributions. It's a very efficient way to support charity and also save tax dollars at the same time. What's interesting is this has now been around for about 5 years on a permanent basis, and we're seeing the number of QCDs going up, and we're seeing the average dollar value of those qualified charitable distributions going down because more people are doing it at more levels. So again, that's a quick review of the Secure Act, things to think about around your pension, talk your traditional IRA, talk to your advisors, again, about what is best for your situation. So let's talk about an older tax law, you know, all this new stuff last year or so. How about in 1997? If we were live, and I think Jennifer already mentioned this, I like to be with a group and I say, how many people have lived in their home 30 years? Put up your hands. And probably most of the people in the room will do so. And then I go, well, how many people have been here 40 years in their home? And a few hands go down. And at 50 years, a lot of hands go down. And then if somebody has lived there 60 years, there's maybe one person in the room who's lived in their home more than 60 years. It happens. It's almost a guaranteed statistical fact. I'm not good at math. But what happened was, historically, before 1997, you carried forward the capital gain you received from selling a home to your next home. And then once you reached the age of 55, you had a one-time chance to take, it used to be $68,000 of capital gains away from that accrued capital gains. Don't worry about that. In 1997, if you lived in your home 2 of the past 5 years, you could exempt $250,000 of gain if you're single, $500,000 of gain if you are a couple. And so it's much cleaner, much simpler, and it is far more generous than what the old legislation had. So this is something that you need to think about. Talk to your advisors, your CPA, your accounting people about this, because it will have an impact potentially on selling your home timely and what your tax liability will be. But remember that defining your cost basis is important. Defining permanent improvements you made to the home, for putting on a new roof, replacing a water heater counts. Certainly, what else would be a new furnace going into the house? All of those contribute to your cost basis. There's a third component of defining your cost basis, which is called fix-up costs. So within 60 days of listing your home, before you list your home, you can start painting, patching, fixing, new carpeting. All of those fix-up costs to make the house look good and marketable can also go into your cost basis. So 97, the law changed. If you live in the house 2 of the past 5 years, you can exempt $250,000 single person, $500,000 couple, but make sure you get all of your cost basis together. It's very important. So let's think about capital gains. Capital gains are being bandied about a lot these days. There's a lot of discussion about it. Basically, capital gains is the accrued value of an asset while you've been holding on to it. And when you liquidate that asset, when you sell that asset, you have the difference between what you paid for it and the selling price that you received. The net selling price is a capital gain. And so many people will be liquidating assets or selling real estate as they get older, or you consider moving into a PSL community. So right now, stocks are highly appreciated relative to the old days, if you will. Properties, real estate is the prices continue to grow. So there are a lot of highly appreciated assets out there. And what happens is, given the tax environment and the reality of capital gains, that when you raise cash through these assets, you may have sticker shock of tax liability that occurs. So again, here's what it looks like in Pennsylvania. The federal capital gains tax rate is 23.8%. That assumes that you sell that asset, that you are in a higher bracket. And so what happens is it's a 20% is the highest taxable capital gain percentage. Then there's the 3.8% Medicare surcharge under the Affordable Care Act. So when you sell a couple assets, your income's going to jump. You may be well into that 23.8% federal capital gains rate. In Pennsylvania, the 3.07 rate applies to everything. So you may be looking at around 27% of your the income you receive being taxable. So again, it's a pretty stiff number, and you need to pay attention to your capital gain situations. There are some solutions though. We use the term charitable filter. I like the term charitable filter because it's a way to minimize your gain exposure. You can bypass the big chunk of capital gains tax with an asset. You can create a charitable income tax deduction, and you can generate lifetime income using charitable filters. And at the end of the day, what you are doing is making a future gift to a charity or charities of your choice. And most charities, PSL included, are happy to work with you around these issues. But again, a charitable filter can help you reduce your capital gain tax exposure. So let's meet Bill and Lara, 83 and 81. They're not real people. Don't look for Bill and Lara when you visit a community. But they're going to move into a PSL community, and they're selling their home. Current market value is $300,000. They paid $50,000 for it. They have a potential gain of $0. And you ask, wow, why? Simple answer. What happens is, remember we said you have the $500,000 gain as a couple. So they could, the selling price could be higher and they would still not pay any taxes. If it was just Bill by himself or Lara by herself, they would still not have to pay any taxes because, again, a single person can exclude $250,000 of gain. So 250,000 plus 50,000 equals the current market value of 300,000. No tax liability. But what if Bill and Lara needed an additional $200,000 for the entrance fee? And I'm going to make up Bill and Lara as very wise investors who bought Amazon stock for $18 a share in 1997. You go, well, gosh, who would ever do that? I will tell you that we have had situations like this. We've had situations like this with Tesla stock. We've had situations like this with Berkshire Hathaway. We've had situations like this with Apple. It is those growth stocks don't pay you money, but they grow like crazy. So in this situation, they bought the Amazon stock at $18. And when I set this up, it was roughly about $3,300 a share. So they sold 60 shares out of their portfolio. And what happens is they would have a taxable gain in this scenario of $197,000, which would equate to $53,000 in additional taxes from selling that stock. So there are ways to minimize that. One is the charitable remainder unit trust, and the other is a charitable gift annuity. The unit trust has a lot more alternatives and options. It fits so many wonderful situations. We've used remainder unit trust with timber, trees, timber. We've used it with Krugerrands. We've used it with a Ferrari. We've used it with porcelain liquor bottles. You can do all sorts of things with the trust. With the charitable gift annuity, generally is cleaner, simpler. You can use liquid assets, usually appreciated stock or cash. And well, let's take a look. The gift annuity is a simple way to show how you can save money. But what we try to do is to look at your situation, to understand what your goals are, just like Jennifer and her team look at what your objectives are in the community. We look at what your objectives are financially. And we want to work with you and your advisors to help you meet key goals, and it's designed to support specific needs. So this is where we work with you and your advisors in fitting what is an appropriate way for you to minimize gain, optimize income going forward. The basics of a charitable gift annuity is that it is only 1 or 2 lives and it is irrevocable. Once you do it, you're locked in. The payments are a partial return of principal. The payments eventually can become fully taxable. And they only become fully taxable if you live longer than the IRS expects you to do so. So my favorite tax tip of the day, if you take anything else home, is do a charitable gift annuity and live longer than the IRS tells you you should. Just a little tip. But the gift is locked into the charity that you write the gift annuity with. So if you write it to PSL, it would be tied into your community. If you write it to the Red Cross, it would probably be tied to your local chapter. All of this, the issuing entity is the beneficiary of the gift when you pass on. So again, very straightforward. This is a quick look at the current charitable gift annuity rates. Age 75, 5.4%. Your charitable deduction is equal to 45% of the gift. And that's, if you gave a charity $1 today, that charity has that $1 to spend. But when you do a charitable gift annuity, the charity will eventually receive the asset, but the IRS in its wisdom tells us what that charitable gift is worth in today's dollars. So an age 75 person doing a charitable gift annuity would have a 45% deduction. A 90-year-old person and above would have an 8.6 payment and a 62% deduction. And there's a lot of factors that go into this, a lot of discussion, happy to discuss the things around it. But the key is that if you're a single person, your rates will be better. If you're 2 people, the rates will be lower because they're based on 2 lives. And we're always happy to give you a proposal you can take to your advisors about this. So Bill and Lara have moved. They've moved into a PSL community. The CPA just told them the $53,000 tax bill. They go, oh my goodness. So what they did was they took 60 more Amazon shares. Let's say they had about 400 and they're not getting any income from it. They took 60 more Amazon shares. They put it into a charitable gift annuity. It created a taxable income tax deduction. It created an income tax deduction that they could write off and eliminate the taxable gain. And it gives them $11,400 of income a year. So they've converted that Amazon stock that they bought so inexpensively into a steady revenue stream and a very happy life in their PSL community. So they have financial security and more time to relax. So once again, that is a very quick overview of some interesting tax considerations, estate planning considerations you need to look at. We're always happy to discuss them more with you on a personal level, but most importantly, like everything, please talk to your own advisors. And with that, I'd like to turn it back to Jennifer for her to follow up.
Yes, thank you so much, Bill. We're now excited to answer the questions that you've been submitting throughout the event. I've seen several questions come in. Thank you so much. So we have myself, Cindy, Maggie, and Bill with us to answer questions about financials. And we also have our panel of senior living experts that have been here from previous events. They're on standby to ensure that we can answer all of your questions. So Stephen, what questions have we received so far?
All right, so like Jennifer said, we have received a bunch of questions so far, but if you are sitting on a question that you really want to ask, feel free to click on that Q&A button at the bottom of the screen and type that question in so we can get to addressing that. So the first question that we have, and this came up when we were doing the financial worksheet, was what level of care are included? Independent living, assisted living, memory care? How does that work?
Good morning, I'll take that.
Perfect.
Yeah, the CCRCs are designed to accommodate the progression of increasing needs, which do include independent living, personal care, sometimes assisted living, and memory care, whether it be in skilled nursing or in personal care. Every community is unique. So I would encourage those that are interested to reach out to your particular community to inquire each of those levels with respect to their specialty.
Great, thank you so much. The next question, I'm going to send this one to Julie over at Glen Meadows. Julie, the question is a resident able to start at one community and move to another community if necessary to be closer to family? What is the impact on the entrance fee and contract in that situation?
Thank you, Stephen. Yes, one of the nice things about living at a Presbyterian senior living community is you do have the ability to transfer from one community to another, and you have a priority status for that transfer. In regards to your entrance fee, it will transfer with you to the other community you decide to move to. If by chance that fee at that second community is higher, you'll pay that difference, and you will likely have to sign a new contract.
Great, thank you.
Mm-hmm.
I have a question here for Bill. Are you still with us, Bill?
Hello. Yep.
All right, perfect. The question is RMD required for 2021 or when you reach age 72?
Good question. It is when you reach the age of 72, you are starting, that's when you have to start taking your required minimum distribution. So until you turn age 72, you have a traditional IRA, you don't have to take any money out. And that's up 1.5 years from where it used to be 70.5. So again, required minimum distribution starts at 72 and it is there forever.
Great. We have a question. I'll send this one to Jennifer. Are there PSL communities located in California?
Not yet. Our communities are in Pennsylvania. Majority of them are in Pennsylvania. There's one in Dover, Delaware, 2 in Maryland, and 1 in Ohio.
Thank you. Got a couple more questions here, but again, just wanted to remind everyone we have a few minutes left. If you have any questions that you would like to ask, go ahead and click on that Q&A button and type it in so we can answer that for you. The next question I'm going to send over to Maggie. Maggie, what happens when I run out of funds?
When you run out of funds, the Benevolent Care Fund is there to support you. Benevolent Care is available to all of our residents, regardless of their stage in the living progression, whether it's independent living, personal care, or skilled nursing.
Great, thank you. Question for Rebecca. Can I move into a PSL community without selling my house first?
Question. So in a perfect world, we would love to say that your home will likely sell by the time your apartment's ready for move-in, but that's not always the case. So we try to be as flexible as we can here at PSL to allow residents to move into their preferred community and begin benefiting from, the apartment amenities and offerings without having to sell their home ahead of time. So we're able to delay these payments by offering promissory notes and open-end mortgages for up to 65% of your entrance fees. If you'd like more details on that, I would definitely recommend reaching out to your preferred community.
Great. Another question, and I'm going to send this one, I think, to Cindy. Can I lock into a contract at the current price, even though I'm not ready to move for 2 years?
I guess that's one that I think I'd have to follow up with our team. Jennifer, do you have more information on that? Typically, we don't block in for that period of time. So
change every year. They change annually. So unless you've signed the contract and you're starting to pay the monthly fee, then you can't lock in the entrance fee up front.
Correct.
So Cindy, a question along those lines. How much money do I have to have in order to move into a PSL community?
Well, just as you heard from this presentation, we have a lot of different types of communities, types of contracts, and everyone's financial situation is different. So it really depends on your financial resources, your annual income, your financial assets. And so the best recommendation for that would be to reach out to the community you're interested in, reach out to the sales counselor there, and they'll work with you regarding your financial assets and where you might fit into that community or another PSL community.
Great, thank you. Let's see. Does long-term care insurance cover my time at the community? Casey, could you answer that one?
I sure can, Stephen. Thank you. That's a very common question we get here at our communities. And to answer it, independent living is not covered by a long-term care insurance, but if you want to speak with your insurance company, it will often cover personal care, assisted living, and home health care.
Great, thank you very much. And then it looks like we have one more question here. We have just another minute or so. So if there are any other last minute questions, feel free to click on that Q&A button and type them in. This last one for right now, unless we get any others, I will send over to Bill. Can I write off my medical expenses on my tax returns?
Yes, you can. So long as you itemize your tax return, you use Schedule A. And secondly, your medical expenses are in excess of 7.5% of your total income. So again, the way it was designed for catastrophic medical expenses. And the rules have sort of expanded over time. Mentioned long-term care insurance premiums. Certain long-term care insurance premiums can be treated as a medical expense. You need to talk to your agent about that. Your Medicare supplemental stuff could be treated. Again, this is where your accountant can tell you what's best for your situation. But medical expenses are deductible in excess of a certain value. And there's a wide variety of things you spend money on that can be included in those medical expenses.
Great, thank you. So unfortunately, we are out of time for today. We do have a few more questions that we have not had a chance to get to, but we are going to follow up with those questions individually via email. So keep your eyes peeled for an email from one of our fantastic panelists here to address any questions that we haven't had a chance to address live today. But I did just want to take this moment to thank you all for joining us for our Waypoints event. There is one more event as a part of the Waypoint series that we encourage you all to attend. We'll send out an email afterwards regarding the next event. But if you'd like to get details sooner than that, you can visit www.psl.org/events to learn more. Thank you so much for joining us today. We hope you enjoy the rest of your Thursday and have a fantastic weekend. Bye-bye.